Course title: Accounting Theory and Practice. Module 1: Quantitative Foundations and Cost Systems in Accounting. Introduction. Welcome to Module 1 of the course, Accounting Theory and Practice. In this module, we delve into the mathematical and analytical foundations essential for effective accounting decision-making. Topics include matrix algebra, linear and quadratic programming, cost systems, standard costing, variance analysis, and a range of analytical techniques used in accounting practice. 1. Introductory matrix algebra in accounting. Matrix algebra provides a framework for representing and solving systems of equations, commonly used in accounting to handle large datasets and model financial relationships. A matrix is simply a rectangular array of numbers arranged in rows and columns. In accounting, matrices help analyze financial transactions across different time periods, departments, or product lines. They are particularly useful in budgeting, consolidating financial statements, and resource allocation. Matrix operations like addition, multiplication, and inversion facilitate efficient computation of multivariate data. 2. Linear programming in accounting decisions. Linear programming is a powerful optimization technique used to maximize or minimize a linear objective function, subject to a set of constraints. It is especially relevant in accounting for resource allocation, cost minimization, and profit maximization. A classic example in accounting is optimizing the production mix to maximize profits given constraints on resources like labor, raw materials, and machine hours. Accountants use linear programming models to assist management in making data-driven decisions for operational planning and budgeting. 3. Quadratic programming and its relevance. Quadratic programming extends linear programming by incorporating quadratic terms in the objective function. This allows for modeling more complex scenarios where the relationship between variables is not strictly linear. In accounting, quadratic programming can be used in portfolio optimization, where the goal is to minimize risk while maximizing returns. It can also apply in cost-benefit analysis where diminishing returns or increasing marginal cost are considered. 4. Cost systems, concepts and classifications. Cost accounting systems track, record, and analyze costs associated with the production of goods or services. These systems are crucial for pricing, budgeting, and financial control. Cost systems are generally classified into job order costing, process costing, activity-based costing, ABC, and standard costing. Each system suits different types of industries and production processes. For example, job order costing is ideal for custom production, while process costing fits continuous production environments. 5. Standard costing and control. Standard costing involves assigning predetermined cost to products, services, or operations. These standards serve as benchmarks for measuring actual performance. Standard costing is instrumental in budgeting and variance analysis. It allows organizations to identify inefficiencies, control costs, and enhance decision-making. Deviations from standards, known as variances, are analyzed to determine their causes and implement corrective actions. 6. Input-output analysis in cost accounting. Input-output analysis is a quantitative technique used to examine the interdependencies between different departments or production processes within an organization. This method helps accountants understand how changes in input quantities, such as labor and materials, affect outputs, finished goods or services. It is valuable in evaluating the ripple effects of cost changes across various functions and optimizing resource utilization. 7. Mathematical analysis of variances. Variance analysis is the quantitative investigation of differences between planned and actual figures. Common types include material, labor, overhead, and sales variances. Each variance can be further broken down into price and quantity components to identify specific causes. For example, material cost variance can be due to differences in purchase price or usage quantity. This analysis enables management to pinpoint inefficiencies and make informed decisions. 8. Break-even analysis. Break-even analysis identifies the point at which total revenues equal total cost, resulting in zero profit. This is critical in decision-making, especially for pricing and cost control. The break-even point provides insights into the minimum sales volume needed to avoid losses. By understanding the relationships between fixed cost, variable cost, and sales, accountants can guide strategic planning and risk management. 9. Cost Volume Profit Analysis, CVP. Cost Volume Profit Analysis extends break-even analysis by examining how changes in cost and volume affect a company's profits. It is a vital tool for short-term economic decision-making. CVP analysis helps in assessing the impact of varying product prices, sales volume, and cost structures on profitability. It provides a foundation for evaluating new projects, entering new markets, and product line decisions. 10. Sensitivity analysis in accounting models. Sensitivity analysis tests the robustness of accounting decisions by varying key assumptions and observing their impact on outcomes. It is particularly useful in budgeting and forecasting. By examining how changes in variables like sales price, input cost, or interest rates affect net income, accountants can develop more resilient financial plans. 11. ALGOL programming in accounting. ALGOL, algorithmic language, was an early computer language used for algorithm development. Though largely replaced by modern languages, it introduced structured programming concepts that influence today's accounting software. In accounting, programming is used to automate calculations, generate reports, and perform complex analysis. While ALGOL is now obsolete, its legacy persists in accounting systems that rely on structured, algorithmic data processing. Conclusion of Module 1. This module provided a rigorous introduction to the mathematical and cost accounting techniques that support effective decision-making in practice. By mastering these tools, accountants can provide valuable insights and contribute significantly to organizational efficiency and profitability.